investing in gold worth the hype? Concerns over inflation have many investors flocking to buy gold. Indeed, it has advantages. It keeps up with inflation, it's easily bought and sold, and the price tends to rise when other investments are falling. Many newspaper, TV, and internet ads promise extravagant returns to gold right now. But is it worth the hype? Let's take a look at the performance of gold. In 1975, the price of gold was $139 an ounce. Compare that to today, where gold is over $1,400 an ounce. After the market crash of 2008, if you had invested in gold, say in the form of gold certificates beginning in 2009, by the end of 2010, you would have had an average annual rate of return of over 25%. Now, if you had taken that same money and invested into a fund for gold mining companies, a typical gold mining fund would have averaged a rate of return of, say, 50%. Compare this to a typical stock index fund, which would have averaged a rate of return of about 21%. Indeed, over the past 2 years, gold certificates and gold mining funds have outperformed the S&P 500. But consider the long-term historical rate of return to gold. If you bought your gold in 1975 and sold it today, the rate of return after adjusting for inflation would have only been 1.5%. If you had made the same investment, but instead using the S&P 500 index, you would have had an average rate of return of over 8%. One thing to consider when buying gold is that it is subject to variation and fluctuation like any other type of investment, especially over short time periods. If you buy gold and hold it for 5 or 10 years, in some cases the rate of return may be negative. So it's very important to consider other investments when you're also investing in gold. And it's especially important not to put all your eggs into the gold basket. If you're planning for retirement, it's a good idea to keep all investment options open.